Well, good evening, folks. Hope you're all doing very well. I'm going to ask you if you would please give me a heads up on Twitter, 5x5, that you guys can hear me, and you should be able to see my weekly dollar index chart. Wait, let's see how much time delay there is between me speaking to you all and then you give me a heads up. Let me know on Twitter. You can hear me. Thank you, Focus. Alfredo. Tabor, thank you so much for that. All right, so I promise not to keep you too long today. I got tied up myself. Personal family members visiting here today. So, all right. So last weekend, on Sunday, before we had the market open up, I mentioned that I was not willing to take anything as a trade unless it was to show me a move on the daily chart with a close above this wick's upper quadrant, which is right in here. Okay, so you can see we never even got up there. So Monday, Tuesday, Wednesday, Thursday, no interest, no concern, nothing. And I mentioned last week that I'm content with that if it were the case. But I'll show you when we get into the NASDAQ what was obvious and what was something I actually executed on. And you can see that recording on my Twitter feed. But you can see we didn't have that. We had an inside week. So that is, I'm going to take this measurement off here so that way you can see it's no longer necessary here, but I'm still interested to see it try to get above that level. And then we have this wick here. We can measure it like this. So you want to have 105.774. Whoops, I'm sorry. There you go. 105.818. That's consequent encroachment. So if we were to have some one more time drop down in to revisit this inefficiency rate in here, you'll see it more plainly when I remove the fib. But that is consequent encroachment of that candlestick's tail or wick. So if we do get some weakness, that would be a area I would watch, and I would want to see it support that. It's better in that it doesn't do it, because I'm trying not to pick a top on the dollar index with all the things going on around the world. You know, I don't think that we're done yet with it going higher, but you know, I'm completely comfortable with being proven wrong. So I'm going to put these levels back as they were, and when we drop down into a daily chart, you'll see what that is. But that inefficiency rate in here with consequent encroachment of this wick, they overlap together, so that's a convergence between two discount arrays. I'll put that back on here now. And we'll go into a daily chart. And if you recall, and you have the benefit of going back and watching the recording that I live streamed last week, I mentioned this fair value gap here that's shaded. I'm going to color it just a little bit differently, so that way it really stands out. I said that we could draw down into that level, but I don't think just because we go down that, I'm not long dollar if it does that, meaning that it would be shorts forming in euro and cable. Go back and listen to the live stream last week and you'll hear me say those very things. I would want to still see it want to go higher first to the upper quadrant of that weekly candlesticks wick that I mentioned before we drop down to the daily chart. So notice what happened last week. We had Friday, Thursday, Wednesday, Tuesday, Monday. We spent a lot of time down in this gap. So between this candle's high, this candle right here, this candle's low, that's what's being highlighted. So this is a buy side imbalance, sell side inefficiency. It's a fair value gap by classification, but specifically because it's an up close candle, that means it's a BISI, B-I-S-I. and it spent a lot of time in that. The last week commentary, I mentioned how I was placing a limit on my interest in filtering how much interest I can have in the marketplace. So in other words, it had to meet a specific criteria before I would take a trade. And I went the entirety of the week until we got to Friday, and then finally I saw something on the NASDAQ that I was willing to take. But by far and large, my caution last week, I was rewarded with that through the entirety of the week because, as you can see here, it really wasn't doing a whole lot in terms of movement. We dropped down to a 4-hour chart on dollar. I'm going to try to get through this because I want to be with you live with the opening here in about 24 minutes. So here's that daily buy side and balance, sell side efficiency. And you see we spent most of the time here. Look at the bodies of the candles respecting halfway or consequent encroachment of that blue shaded area. See that? So they were taking it lower, and this one here went one more time down into it, and then we're just meandering around. So do we go lower? I don't know. I don't know if we're going to do that because it's Sunday. I mentioned this many times before. Sunday it's a gamble. I don't know how to predict the opening price on the new week, so I have to sit and wait like anybody else and determine what they do from the opening price. So we'll get a new week opening gap. We can see what we see from there going into Sunday, Monday, London Open, New York Open, and how we trade on Monday. So yeah, let's go into a hourly chart. You can see how we were pretty much just going sideways all week. So here's Friday's trading, Thursday, Wednesday, Tuesday, and Monday. So basically range bound. The only thing that was noteworthy and that you should have in your journal is you want to take a look at these highs here. So these respective highs there. If you look at that in relationship to the euro dollar failed to make a lower low as the dollar made this higher high here. So that's SMT divergence. That was a catalyst for euro to move slightly higher, and then this went down, took the sell side out below here. But notice that we didn't get a close below and outside of that blue shaded area, which is the daily buy side and balance, sell side and efficiency. Tipping my hand, again, this is in line with what I was talking about in a Twitter space. I want to see a gap lower opening on NASDAQ. I want to see a gap lower opening on E-mini S&P. I want to see a gap lower opening on the Dow futures. I would like to see, by contrast, a gap opening higher on dollar. Maybe come down, try to fill it, then rush to go higher. That's what I would like to see. It would support the idea of not trying to pick a top on the dollar. It would also confirm what I've outlined on Friday when I was in my trade, but I don't want to carry anything over the weekend because of gap risk. And I didn't notice a whole lot of things happening overseas that would cause a lot of excitement. Of course, I don't have the intel that would be in northern Gaza right now. So whatever's going on up there, it's kind of like a media blackout. So whatever may be happening, we may find out later this week. But all eyes are on Middle East, and there's a lot of concern about that, and that is being factored in and built in, wrapped up into sentiment for the marketplace, and none of it's favorable for risk on. And I think if anything happens this week that is seen as a rally in risk, meaning like euro dollar, pound dollar, NASDAQ, or any of the indices or stocks, if they go higher, I think they're going higher to be faded. That would be my expectation. It would be short-lived and then be met with more shorting. But the dollar index has to start showing me a little bit more in here, because the fact that it's being consolidated and held in a range like this isn't as helpful, because all that does is allow the crosses, for instance, like the euro pound and the Aussie New Zealand, those exotic pairs that are not coupled with dollar. When dollar's in consolidation like that, that's when those unrelated dollar-based forex pairs are permitted to move around freely, and they have exaggerated moves, and it's based on its interest rate differential. So the stronger will move better than the weaker, and the weaker will move softer than the stronger. So when dollars in consolidation as a forex trader, you want to be thinking about, okay, then I need to look at the relationships between the interest rate. So the interest rates between the two currencies that make up a pair, if they're paired together, and they have to be a pair that's not with the dollar index. So since the central bank's holding dollar in consolidation, you have to take your attention away from the majors and look at the exotics, anything that doesn't have a dollar associated with the pair. And then whichever one's stronger versus the weakest, if you compare those two up, that's where the bigger moves are going to occur. And if you look at last week's trading, yeah, I taught this in core content too. It's all on my YouTube channel for free. But I'm just reminding you all, because I know a lot of you are predominantly Forex traders, and most of my students are Forex traders. Don't lose sight of whenever the market is doing this in dollar, if it's consolidating, your mind should be not trying to trade those dollar-based currencies. Start looking at the exotic crosses. And like I said, I want to see it. I would rather see it open gap higher, trade down, and then rally and start moving for the buy side in here and above here, over here at these highs. All right, let's take it on into euro dollar. Here's euro, its weekly chart. And in similar fashion, we had an inside week last week here. So an inside week, I failed to mention it earlier when I was talking about the dollar index. An inside candle or inside range, inside bar, inside weekly range means that the week that we closed, its high is lower than the previous week's high, and its low is higher than the previous week's low. So that means it's usually an indication that there's going to be a large move very shortly, usually within the next two candles. I like to anticipate the very next candle. That would be like this current week that we're opening up here in about 17 minutes or so. When that market opens, or when this weekly market opens, I would expect the beginning of a large weekly range. Now, we may not get it this week. It may be deferred one more week, but usually it doesn't make you wait longer than 2 time frames. So since I'm utilizing the weekly chart here as I'm discussing this, the expectation would be that we expect to see a large range weekly candle. Now, by in and of itself, it doesn't give you a directional prognostication. It just tells you the magnitude of the move. Okay, in other words, how much energy should be shown in price delivery. So you're still required to have some measure of prognostication behind the direction. Are you bullish or are you bearish? So if you have an inside range or inside candlestick or bar, it's usually the very next candle or the next candle after it. So inside candles or inside ranges has a lower high than the previous range and a higher low than the previous range. And all that means is it's compressing. And we expect range expansion, large ranges to come to fruition. Now, if we don't get it, this is for your notes, if you don't get it after 2, like say for instance, we're looking at the weekly chart, if we don't get it this week or next week and it's still range bound, then that usually implies that it's going to consolidate longer, to not anticipate a large range move. So it's kind of like, you got to balance these things out and take from it what you can. But I like to anticipate the very next candle to be a large range expansion or the very next one. And then if it doesn't give it to me, then I go right into scalping, and I'm not looking for like a one shot, one kill scenario, which is what I would favor in these conditions where we're expecting a large range move on the weekly. That would be great for the series of, the daily chart, creating one-sidedness predominantly over the course of the week. So between Monday's trading and Friday's close, I would expect more directional trading given the context that I'm showing you here. Okay, and I've already showed and told you that I favor a higher dollar. That's what I favor. But what I see here at the open with you in a couple of minutes, I'm going to get through this, that will help me decide what I would like to see going into London tonight and then going into New York tomorrow. So I'm kind of like talk over that as we see what the market's doing at the opening. All right, so daily chart. Okay, range bound in here. We did come down into this candle right here on Wednesday and Thursday and just found a little bit of support in here. I'm not terribly bullish. Like I said, I'd like to see this showing willingness to want to gap lower opening and then trade up, fill it, and then work towards moving lower. That's what I'd like to see. Because I'd like to see it doesn't mean that it has to do it. I'm not trying to impose my will on it. But if it does that, then it gives me a lot of confidence going into Monday to anticipate further weakness. That's what I would look for. Doesn't mean I'm going to try to trade on Monday. It just means that that would be supporting the idea that I expected going into Friday's close last week when I was short NQ. Now, if I'm wrong, say we gap higher, we trade down, then I would look for a move on the first half of the week to try to trade up into this area here. And if it fails to do that, then we would resume weakness. But I don't necessarily see that as something I would trade. I wouldn't go long based on that. I still favor shorts, and until proven otherwise or incorrect, and I'm welcoming that opportunity to be proven incorrect. I want to see evidence to support the idea that I'm wrong, and if it gives me that insight, it costs me nothing to get it. Number one, I'm not risking anything because I'm giving you my expectations technically, but I don't have any hardline risk behind it. So I'm still in that intel state where I'm trying to get information and insight from the marketplace risk-free. And then once I get a determination of what I think it may be trying to do this week, it's high probability, then and only then I'd be willing to take some kind of a trade or start calling things out on Twitter again, live. All right, so 4-hour chart. Let's try to get through this a little bit because we're running out of time here. This is really, it's not a market that is, in my opinion, symmetrical, meaning that the price swings are really obvious. They're running for clear liquidity inefficiencies and then going to another obvious one. It's just doing very much the same thing we saw in the dollar index, just marking time, small ranges, a lot of back and forth price action. Can I trade that? Yes. Can some of my students, can they trade on the lower time frames? Yes. But these are the conditions that I try to teach new students to avoid, because there's better markets and better market conditions to trade, and you shouldn't be trying to risk anything in these types of conditions because you don't have the experience to be able to navigate it well. You'll think that the moves are going to continue, and they won't. They'll pull back in the range and retrace it, either stop you out or scare you if you don't use a stop loss, and you start drawing down your account. And if you read the comments on Twitter, there's a number of people that got beat up last week because they still tried to do something. I was recommending that, well, not recommending, but I was suggesting I wasn't interested in taking anything last week going into the week unless it did specific things. It didn't do it. So 60-minute chart. Again, this is ugly price action in here. I don't like that. I don't like the fact that they left this even. There's some gaps down here, and there's liquidity here. So there's sell side here, inefficiency down here. I like the fact that we've taken this buy side. So we mark that out real quick. I don't want to get too wrapped up in the annotations, but we ran it here, one more time in here. Again, I'd like to see a gap opening lower, come back, fill the gap, trade for the sell side here, and trade for the sell side here. That's what I'd like to see going into London tonight, going into Monday's trading. That's the extent of what I have right now going forward on Euro. Cable or pound dollar. This is our weekly chart here. This one here, just not all that excited about it. But longer term, I'd like to see it trade down here, as I was mentioning last week. Sell side resides in here. We have an inefficiency with an order block. So if we get animated on the downside and continuation up on the dollar index, again, this is where I'm looking down here. We do have a sell side imbalance, buy side inefficiency in the form of this candle's low, this candle's high, that single down closed candle. We trade up into consequent encroachment here 2 weeks ago, and then we had not an inside range. We had a lower low on the week than the previous week, but we found support in this area down in here. Okay, and I mentioned that would act, and we'll see it on the daily chart now. I'd like to see it get below that and act as an inversion fair value gap. I think I'm correct in saying it that way, but don't take my word for it. Go back and listen to last Sunday's live stream. It's part of the 2023 mentorship commentary. So this inefficiency, we went through it again here, and I want to see it go down below it and then treat it as resistance, and then move lower into those weekly objectives down here. Okay, so that's what I'm looking at for the daily time frame for pound dollar. And let's still into the 4-hour chart real quick. All right, so we've taken sell side here. The body's respecting that fair value gap. This is just really ugly price action. I really would not touch cable here. It would have to do something really animated to the downside before I would participate in this one. So just know that while I have co-signed and said what I'd like to see it do, directional, and where it would draw to for my analysis, I wouldn't touch this one. I would be more inclined to trade the euro if the dollar index were to resume going higher this week. That might change in the beginning of the week if I start seeing something different, or if I see something at the opening here in a couple of minutes that might change that opinion. But right now, I would favor euro over cable for the week. And you can just see this really sloppy, really not a good week at all to be trading cable if you don't know what you're doing. All right, and now let's get into index futures, because that's where we're at really in this mentorship this year. And I know some of you don't like that because you want me to do just Forex, but you got to get what you can get, right? Everything's the same. Price action's the same, regardless of what asset class. So here's the quarterly shift target I was talking about months ago, and we were up here trading. We broke down, and then last week we had a really nice sell-off in here. Obviously, they're relative equal lows here, so there's sell side below that, and then we have the consequent encroachment of this range right here. So we have midpoint, which is 14,431 and 3/4. I'd like that level. I like to see it trade down in there, but initially we got to see how and if we get below these relative equal lows, there's sell side resting below that. I mean sell stops. So it looks like it's in a hurry to get down there. It resumed off of this sell side imbalance, buy side inefficiency between this candle's low, this candle's high, traded up into that there, and then rejected that. Overshot the consequent encroachment of this wick, but it went into the upper quadrant. We'll take a look at that real quick. It just fell short of that. I thought for sure it looked like it hit that, but got real close to it. Went to mean threshold. Consequent encroachment of this inefficiency of the wick. We treat that the same way as any other gap traded there, and then aggressively moved lower. So I want to see it gap lower than when we closed, and then rush underneath these lows and accelerate down into here. That's what I want to see. Doesn't mean it's going to happen, but that's what I would like to see happen. And it's not meant for you to be taking this as trade advice. Best thing that can happen is for me to get it wrong, and you can see how I would navigate the rest of the week with that insight. So again, sell side resting below here. Got real close into it here. It makes perfect sense for it to be gapping down there below it. And then if it does gap below that and we start to come back up, we'd have to see it respect this inefficiency right in here. It would have to stay below, specifically, that low, but it can spike up to consequent encroachment of this wick. Okay? And I would like to see it stop there, because in this case it would be consequent encroachment of this fair value gap. Then we have the consequent encroachment of this wick, and I wouldn't even look at this volume imbalance because I want to see this volume imbalance act as a breakaway gap. Okay, so I want to see it gap open lower and show a willingness to want to keep going moving lower. All right, and again, sell side in here. Just really ugly price action all through here, and finally broke down, gave a nice continuation with a market maker sell model, which I'll amplify on the 4-hour chart of NASDAQ, because that's the one I operated on. And then we have a bearish order block in here. Market, again, reaching for sell side. 60-minute chart. I have 4.5 minutes here. Sell side imbalance, buy side efficiency here. Trade up into the breaker, which is high, low, higher high. There's the low in the middle. Trades up into it here. leaves a small portion open. That's exceedingly bearish. I'd like to see that. And then we had that nice sell-off in the afternoon on Friday. So we'll be looking for that to continue. And now finally making our way over to NASDAQ. I won't be talking about gold, but I will comment it tomorrow during the New York session on Twitter. So if you're interested in knowing all the business there, and then you obviously see that there. So weekly. Again, down here is my quarterly shift objective. People were getting real excited previous week. Oh, it's going to keep going higher. And then we got this. So it's unfortunate for the folks that like to fade me. But the consequent encroachment of this buy side and balance, sell side inefficiency and sell side here, I expect to see it draw in. I'd like to see it draw here this week. But again, that's what I want. Doesn't mean it's going to have to do it. But we did work up into this old inefficiency that's shaded here. So we trade up into that, and then here is this wick. There, we got above consequent encroachment, and it just fell short of the upper quadrant, which it could have spiked to, would have been just outside that fair value gap in the form of a civvy. So that would have been an allowance for that. Take this off. And daily. Obvious sell side resting down here. Again, I want to see this gap open below here. That's what I'd like to see. I want to see it open right below that blue line right there. And if it opens relatively unchanged, then that means we might have to roll up here a little bit and then resume lower. That's how I would expect that. How far up into this? I would use this consequent encroachment. There. So 757. That would be on that level. So if we open relatively unchanged or above the close, then I would look for it to trade here and then resume lower. That's how I'd treat that. But I'm preferring to see an opening below here to take it right into that liquidity. For the folks that didn't get a chance to hold over the weekend, they would be upset. Like I would have been at 20 years old, not holding over the weekend, because I would have missed out on that really profitable exit. But 50,000, 51,000 is pretty good for a couple hours. So anyway, looking at the 4-hour chart here. This is a market maker sell model. So original consolidation. I walked you through this on the Twitter space. Came back, touched, and revisited the original consolidation here. So it's accumulation, reaccumulation, smart money reversal, low risk sell, first stage distribution, second stage redistribution. But right in here, I saw that it was not willing or hasn't yet gone below the original consolidation out here where sell side is. So in about a minute and a half, it's going to open up. So right in here, inside this inefficiency, that's what I was utilizing. So I would have liked to see it trade back up into this inefficiency and treat that as an area to use as an inversion fair value gap, but it was unwilling to get there. So when we drop down into a 60-minute chart, in here, we're trading up in here and we failed to get into that 4-hour old buy side and balance sell side efficiency that I wanted to see act as an inversion fair value gap. It never got there. And even though it has a relative equal lows here, I'm not worried about that because the liquidity below here, which is based on that larger 4-hour area of liquidity here, that to me is a better draw than this will be. And it's going to be, in my opinion, in a hurry to get down below these lows over here, more so than this to come back up here to get to that, because it's already done a lot of give and take back and forth. So I favored that in the 15-minute time frame. You can see that this is what I worked up. We got a slightly open gap higher. So that's not what I wanted to see. So, and in fact, I actually did a better job of managing the trade on Friday by closing it, by trailing the stop loss real tight and letting it take me out of the marketplace. So this is, again, what I was kind of open up with the commentary. I didn't see anything that was so troubling or worrisome that would have caused a lot of excitement. So I wanted to see how we opened, because there wasn't anything, all of it's bad, okay? I gotta be careful how I say this because I'm sure I'm gonna hurt somebody's feelings and it's not intended to be that way. But nothing is grossly exaggerated. Like I'm expecting things to get worse over there. And because of that, that's going to have reverberations in the marketplace. But because I didn't see anything on the news wires, and nobody I know of that is living over there reporting anything, much more than what we've already anticipated seeing. So there wasn't a larger acceleration to the downside. So do I subscribe to going for a run higher? I'd like to see it shake off this opening gap, break lower, and still go down for the sell side. That's what I'd like to see. Once it gets down and below here, and barring any kind of unexpected event that would cause a lot of people to get freaked out, it could trade down below the sell side here, and then if nothing increases in the excitement or turmoil that's going on over there in the saber rattling and the war stuff that's going on, it could take the sell side here and then go all the way back up to here and reach for the buy side. That's what I would look for if we don't see escalation. So if we see escalation in the wartime things that are going over in Israel and Gaza, then I expect it to resume going lower. If we don't see escalation, I gotta make sure I said that right because I'm doing it live. No escalation, we'll eventually run back up into this the first 2 days of the week. If we escalate, this will stay in place and we'll just keep going lower. Okay, so hopefully that kind of makes a little bit of sense. So because of all the things that are going on, I take a lot of consideration for what's going on. Anything war related, anything that is, violence related, those are a different market condition entirely versus, an interest rate expectation or bad economy things. That's something that, I'm not too concerned about that. I'll trade ahead of things and not be afraid of the underlying risks with it. But these types of events where you don't know how bad things can just pop off and do something unexpected, and it'll happen when you're not expecting it in a time of the day when it wouldn't usually move big. That's usually how it happens. So that's why I've been counseling all of you that are listening to me and hang on like every word I say. You have to be really, really careful right now. Try not to be getting home runs. Trade with the smallest leverage. Use a stop loss. But in here, you can see we have this high, that low, and that high. That makes this down close candle my bearish breaker right here. Because all of this movement hadn't yet taken the sell side, which I was aiming for. I still believe it's still a viable objective. I've not abandoned that, even though we had this really uneventful opening price here. We trade right back up into it here. You can see that candle has my 2 entries here, right in here. So it went up, hit it, came back off, and I got filled there. And then I added more in here. And then ultimately you watch me get stopped with the trailed stop loss right there. So I was leaving it there in case we got this big runoff acceleration down into the sell side on Friday, which admittedly I was kind of expecting that, but it didn't come to fruition. So but that's okay. But that's a nice little run. Nothing else to speak of for the week, but using the information and the logic based on that 4-hour market maker sell model, which incidentally is my last model for this YouTube channel. I will be teaching it. I will be sharing it on October 31st at 9 p.m. New York local time. So that will be the last educational material that will close out my 2023 mentorship on the YouTube channel. It'll close out all of the instructional portion. It doesn't mean I won't do live streams. It doesn't mean I won't do market review between now and November 10th. It just means that there won't be any formalized structured lectures or teachings after that one. It kind of like closes this chapter in Inner Circle Trader for YouTube and Twitter. So that will be it for today. Hopefully you found this insightful. I want you to be careful going into this week. Try not to do too much. Pick your shots. Be very, very nimble. Do not risk a lot and don't over leverage. And until I talk to you tomorrow, Lord willing, Be safe.